Citigroup becomes the latest bank to come out and say the housing bubble in Canada is gonna pop and it's the biggest in the world. So let's get into what exactly they're saying. We all know this housing bubble is just at insane levels right now, but what are they talking about? Deleveraging cycle in Canadian housing inevitable as interest rates rise. I've been talking about a deleveraging event for a long time now. So Yasmin Younes, a global strategist at Citi, rated the Canadian housing market ranked first as the most vulnerable to rising interest rates among developed nations, as measured by a few critical indicators. And we'll get into that in a second, but first of all, let's go to RBC and look at the most recent mortgage rates right now. So you can get a 2-year fixed rate for nearly 7%, and that hasn't adjusted to the recent spike in yields that we've seen. So you're probably talking about that heading over 7% right now. And it is just crazy how much mortgage rates have gone up. And we're kind of in this stalemate right now between buyers and sellers, where we're in this sort of bull trap phase where, you know, the recession hasn't hit in the labor market yet. So everybody's like, oh, the recession isn't happening. Maybe we can just go back into real estate. They're going to cut interest rates, but not saying, oh, why are they going to cut interest rates? You know, asking questions like that, just thinking critically. These people don't do that. And just to show you how loony things are in Canada, if you look at like a 5-year fixed rate mortgage, that is going to cost you 6.2% in interest payments. And if you look at the variable here, it's at around 7%. But if you go and put less than 20% down, guess what, guys? You get a nice discount on that. You get a nice discount. You get 6.8%. So they actually give you less. I mean, to people in other countries, this just sounds bizarre. It sounds absolutely bizarre. Why on earth are they giving you a discount for putting less money down, for taking less risk? I mean, there's more risk on the banks, right? But the thing is, that's because of the government insurance, the government insured mortgage. The banks offer a discount. I mean, this should not be allowed. I mean, regulators should not be allowing this to happen, but it's happened for years and years and years. And it just shows how the government insured mortgage just distorts the housing market. It distorts everything. And in my opinion, should be completely scrapped and will have a massive tax burden when the housing market eventually pops, which is inevitable in my opinion. And also this guy at Citigroup is sharing that opinion too. So let's continue here and see exactly what he's saying. So last year, UBS's global real estate bubble index ranked Toronto at the top of the list of the cities with a housing bubble. So Toronto is the city with the biggest housing bubble in the world. And you know, when I think of a housing bubble, what defines a housing bubble? Well, it's when prices run far, far away from incomes. It doesn't mean prices have to actually be really high. It's just whether they are high compared to what they've been in the past, compared to incomes. And when they decouple from incomes, that's when you're in a bubble. And we've seen that time and time again with every housing market bubble that we've seen in the past. It's when those housing prices decouple with incomes that we see that happen. So clearly interesting. And let's continue on and see what else he's saying here. What are his 3 critical indicators? Colmar asserts that highly inflated home prices are a fallout of the easy money, low interest rate policy instituted by the Bank of Canada since 2008. And I totally agree with that. And it's like we've discussed before, you know, if you were using a more truthful rate of inflation and it wasn't an inflation rate that was heavily understating what the actual inflation is, the CPI I'm talking about here, then guess what? You would have never had these low rates for so long. So the fact the CPI is so manipulated is part of the reason that we're actually in this mess. Remember that. It's kind of interesting. So Colmar believes that there is a high risk of a deleveraging cycle as mortgage rates continue to climb, particularly as Canadians have seen debt to income ratios and total debt burdens climb. The amount of Canadian leverage in the system versus incomes is pretty astronomical, and we've seen debt servicing going up dramatically, Colmar notes. Canada's house price to income ratio stood in June at 136.3%, the highest amongst all developed economies, as a report by Citi Bank. Colmar believes that the bubble will eventually pop. There's a definitive risk here that as mortgage rates go higher, or if unemployment were to rise, or we hit the next recession, then this thing does go into a deleveraging cycle, which is exactly what the yield curve is predicting. You know, the yield curve is predicting that that is going to happen. We're going to head into a recession of severity that we haven't seen since the 1980s 1997 stock market crash, Black Monday, and we haven't seen since that happened. And that was like 10 years almost of recession, essentially. Even though the official data figures don't show it, you can definitely see that growth really stagnated for a long time. And then once again, it was interest rates that came into the rescue after 2001 that then added fuel to the fire, and then 2008 added even more fuel to the fire, and it's just kind of been off to the races since, even though we saw that real estate bubble back in the late 80s here in Canada too, which popped. So it's interesting. People think bubbles haven't happened in Canada, but they have as well. So Colmar believes this deleveraging cycle is inevitable. Despite the efforts of the OSFI, Canada's financial regulator, to ensure banks and mortgage holders from the fallout of extended amortizations and negative amortizations as homeowners grow increasingly unable to pay off the interest on their mortgages. And, you know, we've talked about the OSFI many times on this channel. Who is that run by? Banks. Obviously, what they're going to do is just really basically say, oh yeah, we're doing it. We are the regulating agency and we're here. We're doing things to, you know, help safeguard the financial system and everything like that. It's all a front, basically. What they're actually doing is essentially nothing. As we've covered on this channel many times, nobody is doing anything at this point, but everybody is acknowledging the risk. And I just find that utterly hilarious, to be honest, considering the risk and considering the size of this bubble. I mean, if we go to Canadian mortgage debt, this is an old chart, but it's an interactive one by Better Dwelling, and you can see how mortgage debt around 2001 just started to go parabolic, and then it really started to rip into the new paradigm phase in 2020. That was when it just went absolutely parabolic, and you just saw this insane growth. We went from 1.63 trillion in 2019 to over $2 trillion as of October 2022. $2 trillion. So just like, it's just insane. More than the economy's output in mortgage debt, and then you add in credit card debt, you add in private business debt, and this is just a terrible economic storm that we see coming. We have to prepare for it, and that's what we're doing on this channel. I hope you're doing that with your personal portfolio or whatever you can, whether it be just buying more food, whether it be just preparing to possibly lose your job and having other things lined up. I mean, there are all kinds of different things that we can all do to safeguard ourselves for a recession. And one thing isn't to just say, it's not going to happen. This is all doom and gloom FUD. Anyways, let's continue on here and see what they're saying. So really interesting. So he believes the deleveraging cycle is inevitable, and I think that is very right. And then you've also got Canada's likely sitting on the largest housing bubble of all time. This was BNN Bloomberg that put this out, but it just talks about the level of debt and, once again, debt to incomes. I want to bring you to this chart because this chart, which comes from National Post, really illustrates the bubble. It really shows how big this bubble's actually got. You cannot avoid looking at this chart and just thinking, wow, yeah, it's obvious that this thing has got way ahead of itself. If you look at incomes, typically housing prices have been correlated to incomes, and you can see how they've corrected in prior recessions as well. So 1981 here as well. So you can see a recession happened then, home prices came back down, and they had gone above incomes for an extended period of time. Then they came back down, they went under incomes, and then you had a similar thing happen at the end of the 80s, like I described, and then home prices came back down to reality again, and they once again went under incomes. But look how far away we are from that right now. I mean, the pain that we would have to endure to get down under incomes would be, oh, it would just be unbelievable, unimaginable. I mean, for home buyers, they would just be looking at this and thinking, great. But in reality, at the time, most people would probably be fearful, because that would be a massive time of fear when essentially you're in the depths of a recession / depression. And that could cause that to come down if we do enter an economic depression. I think we're already in a recession right now. You know, the GDP numbers don't lie. We're barely posting growth here. They deflate the GDP numbers using the CPI numbers, which we know are incorrect. So if you adjust them to more realistic numbers, we're already in a recession. So then what are we heading into essentially? What is the yield curve pointing to? And it's essentially a depression, or at least a prolonged depression, stagflation, whatever you want to call it, is what maybe it's pointing at. But the housing market is a big component of the economy here in Canada. And you know, housing markets globally generally follow each other actually. It's just that different housing markets are in different stages of their bubble. I mean, just look at what's happening in Vietnam, and there's loads of parallels with that to what's happening in Canada, and the same with China. And you know, everyone's at a different point in the cycle, but you see the same types of events that cause these things to fracture and break down. And in the end, what ultimately it comes down to is the lenders don't want to lend anymore because real estate is seen like, oh, hold on a second, we don't want to lend in real estate. I mean, think about it. If the banks are just dealing with massive amounts of foreclosures, people who are not paying their mortgages, are they going to want to write new loans? And is that what investors are going to want to see them doing? No, absolutely not. That's when money gets tight and interest rates can be at rock bottom then. That's what people forget. So you got people betting on lower interest rates, which they might be correct with that, but what they're not betting on is tight money, which is a totally different environment. It's an environment that I've experienced myself in England post GFC Global Financial Crisis. So it's kind of insane, but this is where we're at. And then, you know, we've seen things like this time and time again. You know, housing bust. Canadian Uber driver bought a $2 million Ontario home that he can't close on. We covered this a while ago, but this story is just so crazy that I had to share it again because it shows kind of the fraud and just the unbelievable things that have been happening to keep this housing market going. You know, a lot of people say, oh, there is no bubble here, there's no bad lending here, but look at this. First-time homebuyer Gutcher and Rehal agreed in October 2021 to pay nearly $2 million plus $90,000 in upgrades for a single detached home that would house himself, his wife, and his two children and his mother, CBC reported. And, you know, he would need to rake in an insane amount of money that he doesn't have. And this guy is an Uber driver. So how he even got like a pre-approval for a loan back then is unbelievable, but so many people did. And, you know, it's not an isolated case. We went through back in 2021, a guy who was able to get a mortgage who was earning $80,000 a year on a $1.6 million home in Vancouver because he said he was going to rent the basement out as an Airbnb. He was able to get that mortgage through with a private lender. And now we've got the reverse of that. Private lenders are pulling the liquidity away and the banks don't want to take them either. So there's a lot of people, those are getting the rug pulled first. And that actually happened coming up to 2008 as well. The subprime were getting the rug pulled first. And that was actually a good thing. Little did they realize. It actually eventually filters through to prime, and they were the main reason for the financial crisis. And what happened was actually the prime borrowers, they were the ones that got most foreclosed on in 2008. I'll link the NBER report that states that came out in 2015. It was an analysis of all the foreclosures that happened in 2008. And what it showed is that most of them were prime borrowers, and the subprime borrowers, the foreclosures started before that. And in this case, it will be just them selling, them able to get out, maybe doing a short sale with the bank, cooperating with the bank to get it sold. But the prime borrowers, they're not going to have that luxury because they are the majority. So when they all come to market, it's going to be a race to the bottom and all hell will break loose in terms of the financial system because you've got so much money that is stacked on top of this. And, you know, to everybody who's got wishful thinking, this is not collapsing, everything is fine, this video is just FUD. You've just got to look at the real residential property prices in Canada. So this is adjusted for the CPI, and you can see that, you know, this is the biggest decline that we've ever had in property prices in Canada, and it's happened at an unbelievable speed. And obviously with speed of decline, you get volatility. You're going to get volatility up as well as volatility down, and that's what people forget. That's what causes these things to be so emotional. People come in and they think, buy the dip, buy the dip, buy the dip, because that's what they've done for the past 10, 20 years. They don't understand where the economy is. Do you think they're looking at economic indicators? They're looking at manufacturing PMIs and things like that and saying, yeah, things don't look that great. Or they're looking at the labor market and seeing that things are deteriorating. I mean, it's like the whole moving to Alberta thing that we discussed in a whole series on this channel that I thought was very interesting. Those people people obviously aren't looking at the labor reports that are coming out, and they don't care. What I use that argument to show you is how bubbles are driven mainly by emotions, where people just ignore what's going on versus actually looking at the data. We're just going to stay put, see how things play out, and then make our decision on our move. No, they're like, we're going to move now because we want to move now, and oh, we just want to buy. You know, it's things like that. But that's just a fascinating thing that I thought I would bring up, because I think it's fascinating anyway. You might not find it fascinating. But when it comes to real residential home prices, you can see the decline is unbelievable. And when you look at affordability, it is just absolutely insane. And this was back in 2021. But obviously, this has just gone even further because of interest rates. So even though we've had a decline, the interest rates have just skyrocketed here. So they've only decoupled further away from income. So the people who've bought in the bull trap don't even realize that they bought at even higher prices than actually where prices peaked in 2021. That is the insane thing. So people who bought here in 2023, they actually took even more risk than the people in 2021, even if they got a lower price, if that makes sense. So it's kind of insane. This housing market, I find it a fascinating topic. The economics behind it, again, fascinating. It's going to be really interesting to see what happens moving forward. Obviously, I cannot predict the future. I'm just looking at probabilities. I'm just looking at the data under the hood of the economy to see what's happening. But we'll continue to monitor that as things progress here. If you enjoyed this, you might like that there. You might also like this playlist here. And if you're looking for a VPN, then go to expressvpn.com/marketmania. Honor to